morning and welcome to House Advisors, yet another show. My name is Hamid, your host today, and in today's show we have a fabulous range of topics that we'll be discussing, in particular about finances. Last week we promised that we will bring you some information about the changes that's happening in the world of financing for real estate, and we are excited to bring that information to you. And the reason we want to bring this information at this moment is because there's a lot of things happening in terms of interest rate changes, in terms of fiscal and monetary policies that the government is enacting. We are in a very peculiar situation in terms of markets, because the markets are looking like a runaway horse. Every which way you see it, in particular in the GTA, you'll see that the prices are going out of control and there's no market equilibrium. Part and parcel of that problem is the marketing of financing products and financing services and financing solutions that is available in the marketplace. And part of the solution, or part of mix of that solution or problems, is actually an organization called CMHC, Canada Mortgage Housing Corporation, which is a crown corporation which allows or helps people, allegedly, to secure financing for their properties, especially in particular people who are first-time buyers or do not have the 20% down payment. So let me explain to you what I mean by CMHC as part of the problem or part of the solution. Conventionally speaking, there are two types of mortgage. A conventional mortgage, which means that when you put 20%, you go to the bank and the bank will finance the rest of it. The second part is actually, the second type of mortgage is actually called a high ratio mortgage, meaning that you as a purchaser may put less than 20%. And on a sliding scale from 5, 10, 20, 15, 5, 10, 15, 20, or less than 20, based on that sliding scale, they'll be charging you an insurance premium. And last year, because of the stress testing, they changed their regulation, they changed their policies, and every now and then they actually come up with new policies, new lending guidelines that they will be communicating with all the banks. So what they did last year, they jacked up the criteria for GDS and TDS ratios. And last week we explained briefly about what GDS and TDS stands for. When you go to apply for mortgage, you're getting basically two ratios that the bank is looking at. Number one is your total debt ratio, how much money you make and how much obligations you have. Based on that, they'll be doing a calculation, which was about 40% last year, that your entire income in relation to your entire debt load should be about 40%. And that was their policy last year. That's called total debt ratio. And the gross debt ratio, or that is another metric which only includes your mortgage payment, taxes, your condo fees, and some of the other utilities and costs that's associated with the home ownership. So they will calculate that, and they allow that to be about 30%. And also, for that program to be qualified, you have to have at least a 650 credit score, a FICO credit score. Now, they have, since last year, they have lost a lot of market share. So what's happening right now, they're changing the guidelines. And not right now, the minimum score is about 600 FICO score. And their ratios, they have changed. So now you can have a higher proportion of your income, or you can, let's put it this way, you can have a higher ratio. So it says 44% instead of that 40% last year. So the 40% last year was allowing you to have 40% of your income dedicated to all your debts. That's total debt ratio. This year, that number has changed to 44. Slight different, but makes a big difference when you factor in the interest rate, and also you factor in the housing prices. So the prices have gone up. Now they're trying to capture some market share. Now in doing so, are they actually relaxing or actually exacerbating the market condition? I would argue that they're actually exacerbating the problem for making it even more a crowded marketplace, and also at the same time qualifying people with 600 FICO score. In the long term, what happened in the States also in the 2008 era, I don't know if you can remember that far back, because we tend to have a short memory when it comes to market. 2008, the same thing was happening in the States, where they were, without any proper scrutiny, they were giving out mortgages. They used to be called no doc or low doc or no doc, low documentation or no documentation mortgages. And that actually helped fuel the 2008 financial crisis. What happens is that when you assign or when you allow people to borrow more than they can, and when you allow them to enter in the market without proper qualification, what tends to happen in 5 or 4 years is that those mortgages will become due. And once they're due, a lot of people may not re-qualify for those mortgages. And as a result of that, you might see an influx of properties that are actually coming back to the market. And that might be the beginning of the end of this bubble. Now, I'm not saying this from I don't have a crystal ball, but the patterns are very similar. So hopefully it doesn't happen, but that is the trend is showing that to be on that trajectory. Now, how it's going to be important to you, how it's going to apply to you as a person, as an investor, or as a person that is interested in investing in real estate, is to realize that financing is a central part of your transaction. And before you even embark upon that opportunity to go ahead and do a multiple offer or really go crazy in terms of emotional intriguing and emotional pressure that the market and the agents and the frenzy that's happening around the home ownership or purchase of a home, is to be important to have a concise, a very clear idea of what you can afford. And once you do that, you must always get the help from a professional mortgage broker. There they can help you to assess you in terms of managing your risk, creating a budget, and creating a flow chart and a course of plan, an action plan that you can take to make sure that your decision is not based on a pressure. Because under contract law, anytime you're duressed or pressured to sign a contract under really extraneous situation, that is actually against the law, and most people are not talking about it. You have to be a willing, able buyer to meet a willing, able seller for the meeting of the minds, for a transaction to be legal and consummated properly. So therefore, preparation is key. Now, whether you're a first-time buyer or second-time buyer or even third-time buyer, doesn't matter. Every time you embark upon this opportunity to take advantage of the market situation or enter the market just for the sake of having a place to live, it is imperative to have that plan. It is imperative to have that flow chart. So crunch the numbers, look at the ratios, and if you can, avoid the 20%, the less than 20% down payment. Now, there are other avenues through which you can move forward to mitigate this cost of insurance that they're putting on your purchase. For example, if you're putting a 5%, their premium is about 3.75% on top of the balance you're borrowing. And they put that on top of the mortgage. And when you amortize that over, let's say, 25, 35 years or 30 years of the age of the mortgage, what will happen, if you just calculate the amount of interest you're paying on that, it will be exuberant. So therefore, there are avenues and ways that your mortgage broker can help you to circumvent this extra tax. So this is actually an extra tax that they're putting as a premium of insurance. They're packaging it as an insurance and selling it to you. It is a good risk management from their perspective, and it also sometimes seems as a good win-win situation, provided that the market is in an equilibrium, provided that there is a healthy market out there. So in my judgment, this market is not healthy, and for the people who are not really 100% sure to embark on this market, they might be biting a little bit more than they can chew come the time that when the rates are going up to renew. Now, it is really important to see what are other financing options available. The one option that's available is also a first and second mortgage, and sometimes that is also problematic, but nevertheless, for the short term, that may be a good solution. Then after 1 year, you can combine the two mortgages. Now, I know finance and numbers and mortgages may be a boring topic, but at the same time, it is very important to understand it before you even think about investing in real estate. So in House Advisors, we are a hub of information. We are a hub of experts that are working with us to deliver to you exactly the same top-notch quality information, so that when you embark on the opportunity, you've got the right tools, the resources, and know-how to make the right decision for you and your family. So make sure to make this note down, that financing about 80% of the time breaks or makes a deal, a transaction. So there are competing interests at the same time when you do a transaction in real estate. So your agents obviously want to make the transaction happen because they are not on salary, they're on commission. So sure, there are regulation that's going to help them to, or at least they're claiming that they're working for your behalf, and they have lots of laws and regulation around that to keep them honest and to keep them basically committed to the fiduciary duties that they have a claim that they are advocating. So therefore, you may have a safety net to work with the proper agents, properly trained ethical agents, but at the same time, you have to realize that their interests are kind of like in competition with your interests. The only person that can actually look after your best interest is yourself, and you can do that by proper planning and not to be placed in a place of disadvantage. So, House Advisors is a place you can go. Check out our mortgage brokers, check out our legal expert teams, and even check out our realtors there. They've got a wealth of information that can assist you in putting forward your financial plan in terms of purchasing real estate and investing in real estate. Now, there are other forms of investment that you can benefit from in terms of a mortgage transaction. So there's ways that you can actually do, if you're an investor, there are ways that you can actually reduce your cost of borrowing by leveraging some of the equity that you have in your home right now. And to make sure that you're not over leveraged, again, you must speak to a mortgage broker. These are just preliminary information we are providing you, but you have to corroborate this information. By no means take this information as an advice from us, because we're not giving you advice, we're just giving you indications as to what you got to do in terms of getting the most accurate and most up-to-date information. But nevertheless, we update you from time to time for the changes that's happening in the marketplace. Now, that's one aspect of our business at House Advisors. We are across Canada, so that means that anybody from any part of the country can embark on this opportunity, join House Advisors, and benefit from the marketing and from the initiatives that's available there to expand your market base, to reach out to your community and service their needs at the best possible way with most cost-effective manner. With that said, I'd like to take a commercial break, and when we come back, I'm going to talk to you about types of investment in real estate that you must avoid right now. Welcome to House Advisors, and we're glad to have you back. Earlier we spoke about financing, the rules and regulation of CMHC, what it stands for, and how it can be part of the problem or part of the solution in terms of helping you securing a financing for your investment properties or maybe for your personal residences. Now, when we go about investing in real estate, we always have to look at from two perspectives. From the perspective of cash flow and from perspective of long-term appreciation. So ROI, rate of return on investment, how much it is, and how we go about distinguishing which property or which sector or section of property or which segment of market may be the most prudent or the most beneficial segment to invest in. And when we do that, we realize that the property must carry itself in terms of its cost, and it should be at least cost neutral for you as an investor, or it's ideal to have a positive cash flow. And when we are investing in a property, the following metrics and measurements must be really paid attention to. Number one, what is your carrying cost? How much does it cost? And most importantly, what's your cost of acquisition? And what financing structure are you using? Number two is, what is your rate of return in terms of monthly? How much is it bringing you on a monthly basis? And number three, what are your maintenance costs of the property? How much are you expending to maintain the property? And number four, part of that maintenance is cost of vacancy. So when you factor all those in, and you'll remove about 4% for vacancy, 10% or 15% for advertising when it's vacant, and also leave about maybe 15% on an annual basis for your maintenance of the property, and then you balance that against your cash flow, you will see that your rate of investment or rate of return may hover around maybe someplace 2%, 3%, 4%, which is slightly over the inflation rate, which is a good thing. Well, if every time you have an investment which is indexed based on inflation, that means that you're actually making some money and keeping the inflation at bay, and that keeps your purchasing power strong. Now the next aspect of it is also in terms of how exactly is this property appreciating over time, and how can you tap into that appreciation without a tax event being triggered. And oftentimes people go for refinancing that property and taking the equity out and putting it into another one. I think that's a prudent measure, but at the same time it depends on your long-term anticipation and long-term plan. So therefore you must have a short-term, a medium-term, and long-term vision for your investment as to how exactly you're going to navigate that path. Now, having said that, it is also important to realize what sort of investments or what sort of property or segments you must be investing in. So before I divulge too much into that, I would like to share a little video with you that talks to you. It's one of the gurus in the real estate market, and this person has actually made his fortune in real estate. So he's much more well-versed than me in this topic. So I'd like to present that information to you, and then we can come back and discuss based on that. So without further ado, I'd like to have that video played for you. Thank you.
In real estate, I go, well, what kind of real estate? You know, some people flip houses. Some people, I don't know what they do. They fix them up and then they re-rent them. Or whatever. There's millions and millions of ways. There's warehousing, there's golf courses, there's hotels, apartment houses. What's the worst investment in real estate? And it's vacation homes.
Well, that makes sense.
And and what most losers do is they buy themselves a big home, and then the next thing they buy is a
Vacation home.
Now, did we do that, Kim?
We did.
Yes, we are the biggest losers.
And
We have 3 vacation homes like
yes,
idiots.
and one we kind of rent out occasionally, but it's certainly not an asset. It is a liability.
Yeah, so that's why, ladies and gentlemen, so what should I invest in? I said, well, how about education? I'll give you the next worst, single-family homes.
High income.
High income. For rich people and all that, they want to buy them and flip them and do whatever they do.
But you think about that, and let's say, the market's doing well, the economy's doing well, and so you have this expensive home that you're renting out, and all of a sudden the economy turns, and the first thing usually that people do is they go to something cheaper. So those high-end homes start sitting on.
Or they buy a high-end home, they want to flip it. And then the economy reverses on them
and they get flipped.
They get flipped over. I have another F word for that one. But anyway, the next one are multifamily condos. Oh, Kim and I have had condos. They're almost worse than vacation homes. And the one reason is homeowners associations, HOAs.
Homeowners associations. And they often say, too, the last thing to become successful before the market turns are condominiums.
Yep. So
if all of a sudden condominiums are becoming very popular, you may want to look and see something may be changing in the near future.
Yep. I love the HOA, Homeowners Association. I have other definitions of that name. But Kim has seen me go to war against those guys, and I tell you, you cannot talk to homeowners associations. They could be the worst people on planet Earth. They're horrible people.
Which is a really good point, because if you're investing in real estate, is there a homeowners association you have to deal with? Because a lot of homeowners associations do not like renters. They want owner occupied.
Oh, worse than that, our HOA, when Kim and I were first starting out years and years ago, we just painted one of our units, and they told us to change the paint. I went, wait a minute, we just finished. And they said, we don't like your paint. Well, so I don't like you. And then we went to war again,
Well, a lot of those people...
They called it their attorneys, and I called it my attorneys. It was horrible.
That was people with too much time on their hand.
Yeah, and that's what HOA stands for. People with too much time on their hands and nothing to do would cause problems. And they all think they're professional investors. They're horrible.
You have no issue with homeowners associations.
Jesus. And the next category, moving up the worst list, is manufactured homes. Deals on wheels. So Kim and I attended workshops on deals on wheels, taught by this famous guy. He is really funny. But he said the first thing you do is you have this vacant lot, and you invite people to move their mobile homes onto the lot. And the first thing you do is you buy them a tree. And so you give them this tree, and you ask them to plant it. And they plant it naturally in front of the mobile home, so the home is no longer mobile. I said, Jesus.
They don't want to leave their tree.
Well, they can't get the house out of they have to cut the tree down.
Yep.
And I'm going, God, this guy is a genius, man. I can't believe it, So that was deals on the wheels. I talk about the McDonald's model. What business is McDonald's in? They're in real estate, but you better know the hamburger business. Not only are school teachers, but they're financial planners or financial advisors, they're stockbrokers or real estate brokers. And I get tired of it. As Kim knows, I'm probably not long for this business because I sit there and I say the same thing. Take a class, get educated. It's your money. No, just tell me what to do. And I get sick and tired of it. So that's why, I'd rather go and talk to guys like Rickards, and we're talking about the Ravens, is how to predict the future. Well, it's not easy. It's not that hard to predict the future. If somebody is really stupid, they're going to be broke. Period. I don't care what business you're in, real estate, stocks, bonds, mutual funds, commodities. And most people just want to sit there and be told what to do. I can't believe it. I just really can't believe it. I hated school, but I like learning. And really, it is time. If you're going to get smart, you'd better understand what a real teacher. And to me, I get sick and tired of talking to people who think real estate's about making money. It's a business, and it's a very profitable business for the right people. But 90% of the people are idiots. They don't know what to do. And Kim and I have had partners say, yeah, I know real estate. I bought 6 houses. For what? To live in. Well, buying a house to live in is not the real estate business. So that's why I'm happy to be working with my friend Rickards on The Raven. The Raven is how do you see the future? And one of the ways to see the future is get smarter, or you're going to just keep losing money.
And one comment to that is, people, they work all day, every day for money. I mean, they spend their whole life, they give their whole life to work for money, yet they don't take any time to study money or to study how to grow their money or to study what to do with their money, yet they spend their entire life working for it.
No, and think about fake assets. They give their money to Wall Street. Stocks, bonds, mutual funds, ETFs, and savings. Those aren't assets. They're liabilities to you. But I was told to do that.
I was told to save money and put money in the stock market. But that's all.
Invest
that's as
for
far
the
as
long
their
term.
Education goes.
So that's my frustration. After years and years and years of being in teaching, people still ask the same stupid question. What should I do with my money? Is it real estate? Should I get in stocks? Well, why don't you take a stupid class? Look, your most valuable asset is your brain. It's also your biggest liability. So when I write fake money, fake teachers, fake assets, the chances are you've been listening to some really stupid teachers, poor teachers, like my poor dad. They're good people, but they're poor. And if you don't make the decision, which I cover in Fake, choose your teachers wisely. So that's the story of Rich Dad, Poor Dad, is I couldn't listen to my dad. I love him dearly, smart man.
So welcome back. With that, I just wanted to reiterate some of the key points from that video. Number one is the kind of investment you don't want to be part of in real estate. And number two is that while there are lots of competing interests, in the housing market, you've got your own interests to look after, and the best way to do that is to get more information and actually expand your knowledge base. And based on that expanded knowledge base, take proper, accurate actions. And predicting the future is impossible. However, when you look at the patterns of the market has a certain pattern of behavior that repeats itself, and the numbers do not lie, and the graph and trajectories are actually there to help us to analyze and kind of see the trends. And once we follow the trends, we may be in a better position. At least the guesses we make and the gut feelings that we may have may be more grounded in research and numbers and analytics and market data than just raw emotions or just because somebody said to jump this hoop or do that investment. So we won't be so easily swayed by those opinions. Instead, we'll be approaching everything based on a factual base and based on calculating the pros and cons for ourselves. So the video mentioned a couple of types of investment that it's kind of frowned upon to invest in, but at the same time, we have to realize our own narrative and definition of what it means to have an asset class or to a liability. And oftentimes that comes to rate of return and also appreciation and how effectively we navigate through the tax game to make sure that the profit you're making is actually you keeping it instead of taxing it all the way away and not having any kind of plan. So the key is to educate, inform, and get the right resources. And House Advisors, we do that, www.houseadvisor.ca. You can engage in all our social platforms. Send us your questions, comments, and make sure that you share this video to help your friends and family to make the right decision financially for yourself and your family. So until next week, that we'll be talking about home renovation and how it can be a good leverage for you in terms of propping up your investment and keeping up the investment. Until next week, you look after yourself and your family, and thanks for tuning in.